Nokia stock is currently trading at $12.91 per share, following a high-energy session that saw the price touch an intraday peak of $12.92. This movement represents a significant consolidation at the top of its recent range after a massive breakout earlier in the week. While the broader market might look at this as just another legacy telecommunications company finding a bit of oxygen, the reality is far more aggressive. The market narrative has long been that this company is a slow-moving utility-like play, forever trapped in the shadow of its handset-era glory. However, the data hitting the tape right now tells a completely different story. We are seeing a structural shift in how institutional capital is treating this name. The expectation was for a modest recovery in 5G spending, but the reality is that the company has effectively pivoted into a high-growth optical and AI infrastructure powerhouse. If you look at the recent trading volume, it's clear that something has fundamentally changed. When we see the Nokia stock price holding these levels on elevated volume, it usually signals that the big money is no longer just renting the stock for a quick swing, but is instead accumulating for a long-term shift. This isn't just about cell towers anymore. The real surprise for many retail investors is the explosive growth in their AI and cloud segment, which recently grew by a staggering 49%. Most people still think of this as a value play, but with the network infrastructure growth guidance being hiked from a modest 6% to 8% all the way up to a range of 12% to 14%, we are entering territory that looks much more like a growth stock. This is where the tension between expectation and reality becomes profitable for those paying attention. The general belief, often reflected on popular investing sites, was that the transition to next-gen networking would be a slow grind. Instead, the company is booking billions in orders for AI-specific pluggables and line systems. Many users of the Robinhood app or those managing a Schwab Intelligent Portfolios account might have overlooked this ticker because of its historical sluggishness, but the institutional activity we're tracking through platforms like Interactive Brokers suggests that the smart money is focused on the indium phosphide manufacturing ramping up in San Jose. They are betting on the physical layer of the AI boom, the actual hardware that moves data between GPUs. Let's talk about the intraday movement and what it means for your individual brokerage account. We saw a dip to $12.11 earlier in the session, which was immediately bought up. That kind of V-shaped recovery within a single day is a classic sign of institutional support. It means whenever the stock gets even slightly cheap, large funds are stepping in to absorb the sell-side pressure. If you are using SoFi Invest or a Fidelity trading platform to track these moves, you've likely noticed that the volatility has increased, but the trend remains firmly upward. This is no longer a stock that just sits there and pays a dividend while the price erodes. It's becoming a momentum play. Now, I want to hear from you, because the sentiment on the ground is often ahead of the analysts. Comment below with how many shares of Nokia stock you are currently holding, or tell me if you think the AI infrastructure hype is finally reaching the hardware level. Seeing your perspectives helps everyone gauge whether the retail side is finally waking up to what the institutions already know. Looking at the broader sector, the company is significantly outperforming its peers in the technology equipment space. While some of the big names like Nvidia stock have seen some profit-taking or sideways movement, this specific ticker has been a relative strength leader. This usually happens when the market realizes that a stock has been mispriced for years. The reality of their 45.5% gross margin expansion is forcing a re-rating. When margins expand like that in a hardware business, it's usually because they've moved into high-value proprietary tech where they have actual pricing power. This is a far cry from the commodity-level margins we see in basic 5G radio gear. For those of you involved in online investing or looking for investment help through Fidelity IRAs or other retirement vehicles, the stability here is a major draw. The company ended the quarter with a net cash balance of 3.8 billion euros. In an environment where interest rates remain a concern, having a fortress balance sheet isn't just a safety net, it's a competitive weapon. It allows them to acquire companies like Infinera to bolster their optical portfolio without diluting shareholders or taking on toxic debt. This is the kind of detail that often gets lost in a 30-second news clip, but is vital for anyone doing self-investing. If we look back at the historical business model, the company was heavily reliant on the mobile network segment, the big, expensive radio contracts with carriers. While that's still a core part of the business, the shift toward network infrastructure is where the future value lies. They are essentially building the plumbing for the global data centers that power the apps we use every day. Whether you use the Robinhood mobile app for quick trades or manage a complex portfolio of Fidelity ETFs and Fidelity mutual funds, understanding the shift from mobile to infrastructure is the key to the whole thesis. The business model has also become much leaner. They've gone through a rigorous cost-cutting phase and a simplified operating model that is finally showing up in the bottom line. Reported operating profit moved from negative territory to a solid positive margin in the most recent quarter. This kind of turnaround story is exactly what attracts value-oriented platforms like Fidelity Wealth Management or the automated strategies within an intelligent portfolio. It's the transition from a problem child to a profit engine that creates the biggest gains in the market. Expectations for the rest of 2026 are now quite high. The company is targeting an operating profit between 2 and 2.5 billion euros. The reality is that they have a lot of tailwinds, but there are risks to consider. The shift in fixed networks, where sales declined as they pruned lower margin products, shows that management is willing willing to sacrifice short-term revenue for long-term profitability. This is a bold move that can lead to temporary dips in the stock price, which often scares away the weak hands, but provides a better entry for those using interactive brokers or other professional-grade tools. As we look toward the future, the primary catalyst will be the AI supercycle. We're not just talking about software, we're talking about the physical limits of how fast light can travel through fiber optic cables. The company's new indium phosphide facility is on track to start volume production soon, and that could be the next major leg up for the stock. If they can capture a significant slice of the data center interconnect market, the current valuation might look like a steal in retrospect. In terms of market positioning, we're seeing a clear divergence between those who view this as a 5G laggard and those who see it as an AI infrastructure leader. The expectation was that 5G would be the only story, but the reality of the optical network growth is shattering that perception. This is why the stock has been able to defy the broader sector weakness on several occasions recently. If you're looking at investing sites for the next undiscovered play, the data suggests this might be hiding in plain sight. To summarize the situation, the stock is currently in a high conviction uptrend backed by a fundamental shift in its business model. The transition from mobile-heavy to infrastructure-focused has allowed for massive margin expansion and a more predictable revenue stream. While the market initially expected a slow recovery, the reality has been an acceleration driven by the global demand for AI-capable networks. This gap between what people thought would happen and what is actually occurring on the balance sheet is what is driving the price higher. Whether you're managing an individual brokerage account, using Robinhood fractional shares to build a position, or looking for long-term growth in Fidelity brokerage, the importance of this shift cannot be overstated. The company has moved from a defensive, hold-on-for-dear-life position to an offensive, growth-oriented strategy. The fortress balance sheet and the massive increase in AI-related orders provide a level of support that was simply not there 2 years ago. As we wrap up, it's important to remember that the market is a forward-looking mechanism. The current price reflects the information we have now, but the true value will be determined by how well they execute on this AI infrastructure pivot in the coming quarters. The expectations are set, the guidance has been raised, and now the reality must continue to deliver. This is a high-stakes game where the winners are those who can see through the legacy telecom label and recognize the high-tech infrastructure company that is actually emerging. Keep a close eye on the volume and the institutional inflow, as those will be the primary indicators of whether this move has more room to run. The depth of this analysis suggests that we are witnessing a significant re-rating, one that challenges the long-held beliefs about this company and forces a new reality onto the market. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.